All right, good afternoon, everyone out there. This is Mike Sylvia. I'm here with a special guest, Nicholas Vita from Columbia Care. He's the co-founder, also the CEO of Columbia Care. What we're going to be doing on a weekly basis is we're going to delve into the legal cannabis market locally and nationally across the country. We're going to talk to the leaders in the industry and educate viewers on the sector. And no one better to talk to than Nicholas from Columbia Care. We're going to talk New York, New Jersey, which actually legalized different ways. Some of the federal legislation of safe banking, 280E, and uplisting, which is important to the cannabis industry. So thanks for joining me. How are you doing, Mr. Vita?
Great. Thanks for having me. It's wonderful to be here.
Yeah, I really appreciate you coming on. People might not know about Columbia Care, so just tell me about Columbia Care and how you kind of got involved in the cannabis industry.
Well, we're one of the largest operators in the sector. We're licensed to operate in the U.S. in 18 different jurisdictions, and we actually have operations in Europe as well. I think we're the only company that has a fully integrated platform nationally, and we are in both the medical and adult use markets. So it's a company that was founded back in 2012. I'm one of the co-founders, as you mentioned. And the way I was able to get into the business was really in partnership with actually my first boss and one of my former colleagues from my days back at Goldman Sachs. And we just thought that the cannabis world deserved a better mousetrap. We wanted to develop better products. We wanted to collect data and really make decisions based on information that was unique to the sector and unique to us. And that's the course we've really pursued since we launched back way back when.
Yeah, I don't think people understand the magnitude of what's going on with the cannabis industry. So I'll pull up a quick chart. So people don't understand, it's a $100 billion legal and illegal market. They call it illicit market. It's actually more than spirits and wine. And right as of 2020, the cannabis industry was $17.5 billion, but it's supposed to double, I believe, by 2024, correct?
That's right. That's right. And I think that the great thing about cannabis is that it has so many different applications across so many different subsectors. It's very hard to kind of pin it down to one particular lens, which really opens the door for us to think about product development, customer segmentation, market sort of development in a really kind of innovative and unique way.
And you started in the healthcare profession and with Goldman Sachs, correct?
I was in the healthcare. I was a banker, and then I was an investor, and then moved into cannabis.
And I think was Ben & Jerry's kind of one of the seed investors of Columbia Care?
They were way back when.
Yeah, it's interesting. And you guys started off I believe in Arizona, and you still have a few dispensaries there.
That's right.
Yeah, so I want to start first, and it's kind of probably the biggest news in the last few weeks, which was New York going fully recreational. And it's going to take a while before those sales kick in. There was a lot of kind of misinformation out there, especially like on Twitter, which was that it was bad for the legacy existing MSOs, but it's not true once you looked at the legislation. You guys are allowed to remain fully vertical, and the new players will not be full vertical. You were capped at 4 stores, but now you'll be able to have 8. 3 of those will be recreational, 1 will be medical. Can you just talk about, you kind of happy about the laws as they are written?
Well, New York is going to be one of the largest markets in the world. I think people often think about California as the biggest market, but with almost 20 million full-time residents and almost 250 million visitors a year, New York State has the potential to be one of the, if not the largest market globally for cannabis. What was interesting about the process we went through in New York is that it was a creation of both the executive and the legislative branches. So New York doesn't have within its constitution the ability to go through a voter-driven initiative. And what that means is that the regulators who answer to the executive branch, in this case the governor, and the legislative, the Senate and the Assembly, were forced to work together to come up with a structure that really worked. For us, as one of the original operators in New York, we couldn't have been happier because it allowed us to continue to do exactly what we were doing before, which is deliver the best products to the marketplace in New York with very high standards and with exceptional compliance. And at the same time, it allowed us to really address a lot of the policy and community issues that really revolve and are unique to the cannabis industry. And so not only are we allowed to continue to sort of cultivate, manufacture, dispense, and wholesale, but we're also able to participate directly in making sure that a lot of the social equity components of the legislation not only are sort of properly introduced, but succeed. And so that's a very, very lucky position for us to be in, because we're accustomed to serving stakeholders of all types. And now they've added one of the most important stakeholders that we can serve, which is the social equity priority of the legislature.
Yeah, and what's kind of underserved on information out there is that the medical program will be expanded, and it gets expanded in many significant ways, correct?
That's right. I think if you look at markets like Florida or Pennsylvania, what you saw is a significant increase in the growth rate when they introduced flower and other form factors. New York has done exactly that. So in anticipation of the rollout of adult use, they've materially expanded the form factors that are going to be available to consumers. And as you pointed out, not only will we have under the adult use program 3 co-located facilities, so we'll be able to treat and provide access to both adult use and medical patients, but we'll also have 5 additional medical dispensaries. And that was really important, because if you look at Massachusetts, if you look at Illinois, our numbers have been going, on a very sort of attractive curve from the lower left to the upper right. But that's both for medical and adult use. And so there's been a continued expansion on both sides of that ledger. I think people often think about adult use as sort of the largest part of the market, and right now it is. But when you talk about a market size like New York, which is going to be anywhere between $5 and $7 billion, 30% of that market is going to be medical, 20%, between 20 and 30%. And I think if you then take a step back and think about what the economics are and the importance of being able to serve that community effectively, it's really, I think a great position for the incumbents to be in, which is we can continue to do what we were doing, and then we can also add on these other layers and other products and other capabilities that we've developed outside of New York.
In Virginia, you are one of the 2 publicly traded companies that are actually in Virginia and New York. And Virginia came up with their own legislation, which was 2024, but the governor there got some additional changes, made it so adult use could be this summer. I think it was July. It's a lot different than New York, right? What's it look like compared to New York?
Well, it's a smaller market than New York, meaning there are fewer current registrants, but it's being done in sort of a step change process. So under the original approach, it would have taken several years for adult use to come online. Although there is one area that's very consistent, which is they both are introducing new form factors. So flower is expected to come to the state of Virginia sometime in the 3rd or 4th quarter this year. So you're seeing that sort of the leveraging of the medical program into adult use and the creation of the market through that process. But each of them, New York and Virginia have very different political dynamics, different sort of geographic locations, different histories. But what I think has been interesting is that both of them have viewed adult use as an important legacy. So you've had uniform support from both sides of the political aisle. You've had uniform support throughout the legislature, and you've had uniform support from the governor. In this case, in Virginia, Governor Northam really wanted this to be part of his legacy long term. And that's wonderful because, again, being able to sort of find an issue that can bring both sides of the political spectrum together and really focus on creating economic value, creating improvements in quality of life, adjusting some of the sort of the social matters that have been unaddressed for many, many years, I think creates a very, very healthy dynamic for the communities we serve.
My biggest issue when I see what they've done is they've passed, and people need to separate adult use and adult sales. So adult sales won't happen until, I believe, 2024. Does it make sense to allow adult use and not rec for 3 years? Wouldn't that kind of drive people to the illicit market?
Well, I think that's one of the items, whether you're talking about New York or Virginia, both the executive branch and the legislative branch reserve the right to go back and revisit different aspects of the laws that are currently in place and the regulations that are being considered. In Virginia's case, whether it's Governor Northam's legacy or let's say Governor McAuliffe is reelected to the governorship again because they have very significant term limits. I have yet to see a single sort of candidate for the governorship in Virginia that isn't supportive of this program. And one of the great parts about being in cannabis is that it is a huge economic driver, meaning it is an enormous sort of source for tax revenue that can be redeployed in other sectors. So, it is, would I presume to know how the legislature or how the executive branch or even how the political sort of contests go in the upcoming election cycle? Absolutely not. But what it does make sense is that you now have this foundation in place. And I think that there is going to be a lot of pressure to actually pull forward some of these legislative moves in advance of federal decision making, because the states really want to control these programs and they want to drive a lot of value, not only tax revenue, but also jobs into their own jurisdictions. So there's a really interesting confluence of events that are all very supportive of growth at the local level for cannabis programs.
Yeah, my guess is that they're going to want rec sales in Virginia before 2024, so they can take advantage of the tax revenues there.
That's right.
So you guys recently released your earnings. It's the annual earnings, the fourth quarter earnings, and it was, I looked it over, and you guys are the second fastest annual revenue numbers and the highest quarter over quarter. I'll pull those up for $1 billion or higher market capitalization. So you kind of hear they some of the analysts put people in tier 1, tier 2, tier 3. I consider you guys a tier 1. Tell me why you are a tier 1, because I think you really are.
Well, yeah, I mean, so I think that it would be hard to make the argument that we're not considering our footprint. I mean, we have the second largest footprint in the industry. We're the only other operator that actually has operations in the U.S. and overseas. We've been growing at an exceptional clip, which is very hard for other people to really match. And I think that what you're seeing is the organic growth and organic way we deployed our capital for the first several years when we were still private is now beginning to take hold, because we've spent a lot of money building out infrastructure across the country. And so we have, I would make the argument, more catalysts than almost any other operator, just based on the fact we have so many markets converting from medical to adult use. And that's going to be a huge driver of value. So, if you look at it just in terms of revenue, if you look at it in terms of financial performance, if you look at it in terms of growth, and you look at it in terms of market share, market penetration, market footprint, we're definitively a tier 1 player. But I think everybody has their own way of looking through that lens. And for us, it's really about sort of driving value and driving margins. I think have a better long-term and midterm story and more attractive story. And frankly, I think some of the disconnect in the marketplace has resulted in us trading at a slightly discounted multiple. So we're actually the best value in the sector on top of everything else. So we're pretty excited about where we are. We think that that growth rate year over year is going to continue. So looking at north of 100% top line growth for the foreseeable future is kind of the direction we're heading in.
Yeah, just give people some perspective. 2019, I looked up your financials. 2019, you did $77 million in revenue. 2020, you ended the year with $198 million. You've guided in 2021 to $500 to $530 million. So that's going from $77 million to $500 million in a pretty short window.
Yeah. And we feel very good about that.
Yeah. So the one thing I've seen the biggest knock on Columbia Care from the analyst standpoint is the margin issues. So you have lower margins, but I've noticed one of your big acquisitions lately was G-Leaf. And I think in there, you kind of noted that kind of solves some of the vertical issues in some of the key states.
Yeah, so one of the things that we've always found fascinating is that we made the conscious decision to build our businesses from the ground up rather than simply acquire other people's businesses. I'm a shareholder, just like Mike, and we're actually two of the largest shareholders still as co-founders, which means that we've been very disciplined about the way we actually sort of use the company's resources. I consider capital allocation to be one of the most important factors that will determine long-term success for anyone in this sector. The fact is that we didn't really buy any other businesses until last year. And the reason why we did that is because we had our hands full. We wanted to build out infrastructure the old-fashioned way. We wanted to hire people, build a culture, build an organization, and build a foundation off of which we could then integrate other businesses. And as a result, when you think about our capital expenditure schedule and you think about the way we've actually built out our infrastructure nationally, it really spiked in 2019 and then moved up in 2020. When you look at where our margins have gone, I think in fourth quarter 2019, we had about a 26% margin, maybe a little less. In 2020 fourth quarter, we were north of 43%, 42%. And the reason why I've been able to sort of bridge that gap is because when you build out a business from scratch in cannabis and you're fully integrated like we are, you have to build a building, hire the people, you have to get inspected. And then once you get approvals, you actually have to plant the plants. And it takes a long time for those plants to come online and for you to actually generate revenue. So you actually have negative gross margin if you're building it out from scratch. You spend less money, but it does take longer to get to profitability. where we are today is we've actually hit that inflection point. It was actually third quarter 2020 that we became EBITDA positive. And now what we're doing is we're effectively accelerating all of our scale and all of our infrastructure with targeted acquisitions to really drive our margin profile so that at the end of this year, if our guidance, we've guided to roughly a 20% EBITDA margin, we think that goes up, in future periods. We think that the top line growth rate is continuing to grow just because of the number of markets we continue to build out. I think that if we had been more of a roll up, if we had relied on other people's businesses more aggressively to really drive value, I think you would have seen us turn to profitability sooner, but we have 18 markets. And I think when you have 18 markets, you have to sort of think about the pipeline of acquisitions, the pipeline of organic growth, and how that actually comes online. And for us, maintaining that growth rate and maintaining the trajectory of margin is critical because we think that long term, the way you drive the best margin profile is by having the most scale on a national basis, not just in individual states. If you took our top 5 states, let's say we were only in 5 markets instead of 18, I think what you'd see is an EBITDA margin north of 35%. Very easily. And we can get there because the businesses, as they mature, actually perform really well, especially the way we run them. For us, it's making sure that timeline and that J curve of all the new markets coming online follow suit. So I think we get there. But for us, it's about a marathon, not a sprint. And it's really about sort of demonstrating kind of really certainty of execution and eliminating some of that tail risk that typically comes with integrating other people's businesses.
Curaleaf recently got into Europe. They spent $130 million on an EMAC acquisition. You've been in Europe for a while, but what are you doing in Europe right now? And I know you said Europe is more of like a 3 or 4 year play from now, and you've been a lot more aggressive in California than you have been, say, overseas. Can you just talk about that a little bit?
Yeah, so for us, Europe is very interesting. Ultimately, it's going to be one of the largest sort of global markets. I think the problem is that people often think about Europe the way they think about the US and cannabis. Europe is not one market. Europe is France, it's the UK, it's Germany, it's the Netherlands. And every one of those markets has its own laws and regulations and its own priorities, just like New York, New Jersey, Connecticut, California. And so when we think about driving shareholder value and we think about really pushing cash flow, the European markets will eventually get there. And I think that we're better suited for that type of environment than almost any other organization on the planet because we do have this very strong commitment to medical. And Europe, we believe, will continue to be medical for the most part over the long term. And we sell products, right? We have products on the markets in the UK. We have products on the market in continental Europe. But the fact is that when I think about the size of the market that New York will be in the next 2 to 3 years, right? That's a $5 to $7 billion market. Virginia is probably a $2 to $3 billion market. New Jersey is probably a $2 to $3 billion market. These are massive opportunities that are right now sitting in front of us. California is already a $5 to $7 billion market and still growing. And so for us, when we think about deploying capital and return on invested capital and really building skills internally and creating that foundation, Europe is something that we continue to study. We'll continue to have a presence there, and we'll continue to be very deliberate in terms of deploying capital. But the real value that we're seeing created is being created in the U.S.
Yes, so I want to transition a little bit to the politics, and not to get you into politics and into trouble with some of the congressmen. But the big thing with cannabis is while we're almost nearly half of the country legalized in some form of medical or recreational in the state level, federally we're still considered the cannabis industry is still considered illegal. So I just want to go over a couple of things. So like one of the biggest things is the Section 280E law, which is the IRS code. And what it does is it punishes the industry for being in cannabis because it's a Schedule I drug by the federal level. So I pulled up TrueLeaf because I know you guys don't report it, but TrueLeaf actually reported. I'm just going to pull up on the screen. They had $157 million of income before taxes. They paid the 21%, which is the corporate tax rate, and then the state level. But as you can see on the screen there, the Section 280E brings it to a $94 million tax level, which is what I looked at was 58% tax rate.
Yeah.
So 280E, do you see that going away this year or next year or anytime soon?
Well, it certainly is one of the priorities of the industry and individual players like us to see some sort of normalization. We think it's unreasonable to expect a legitimate business to pay differentiated tax rates just because of a historical association. But it is what it is, right? It's in place today, and it's something we pay today. And as you can see from those financials, it's a fairly significant financial hit. We try to do everything we can to mitigate that tax burden by being fully integrated, because whereas you cannot deduct expenses related to SG&A or retail sales, you can deduct your cost of goods sold. And because we're fully integrated, that's very helpful to us. But it is something that we think a lot about. I think the issue is that we're in an environment where both the federal and state governments view cannabis as a source of tax revenue. And I think that even though it's been scored by the CBO as being neutral in terms of its effect, if the service decided to eliminate 280E, it is something that is not necessarily a priority shared by policymakers, meaning anything that can help to deal with the current deficit and the current spending trends is something that is viewed as a net positive by the policymakers. So we have a bit of an uphill battle there, but I think the great part about it is that if you just look at cash flow from operations, so if you find a way to sort of adjust for that tax burden, what you have is a a very, very attractive business model that can actually generate cash flow as well as free cash flow in either a normalized environment or even in an environment like we're in today with 280E. So if you think about how you would value a business that has 10 to 15% cash flow from operation yields and is growing 100% a year, like that becomes a really interesting sort of sector to invest in.
Yeah, and the one that's got the most traction is they call safe banking, and it's passed the House 3 times since 2019. It's currently in committee in the Senate, and we're hoping something by summertime might come out. And people don't understand is, I'll pull this up. I was looking at your Virginia store, and what people don't see is that cash only, like you see that throughout the country. It makes it for an unsafe environment. I think people that are handling that much cash. From what I understand, safe banking is going to allow a little bit, actually a lot more cash for a lot more lower interest loans. Because right now I've seen some of the loans that cannabis companies are getting are up to 15%. So how is SAFE really going to, I guess I'll ask you, is SAFE is going to be a big boom for you? And do you think it will come out this summer?
I take a great deal of comfort knowing that Senator Schumer and Senator Booker are looking at the industry and trying to find ways to normalize it. Giving any industry, especially ours, access to the financial system is critical, because normal cost of capitals will accelerate consolidation, accelerate returns to shareholders, and accelerate innovation. It allows us to really reinvest in our business. The way I think about the likelihood of SAFE passing, I think it has the most support, bipartisan, bicameral support. I don't think that this is something that the president would stand in the way of passing. Does it get passed as a standalone piece of legislation? That's a hard question for me to answer because there's so many priorities right now. There are $1 trillion priorities being considered by the federal government that are all mission critical from the standpoint of the midterm elections, of the Democratic Party, and frankly the president and the vice president. So I would make the bet that SAFE passes within the next 12 months. I think it's going to have a lot of the provisions that are associated with the MORE Act. And so you'll see a combination of the SAFE Act and the MORE Act. But I just don't, I don't know how it will make that step forward. But when it happens, it's going to be fantastic because it allows us to operate as a normal business. All of a sudden, all of these handicaps that we have to deal with, whether it's accessing mortgages for the properties we own, having bank accounts. I mean, there are some banks that have actually gone so far as to terminate bank accounts for employees. So it's a very, very punitive measure that's I think has really kind of lost sight of the importance of the issues that we're dealing with.
Yeah, I don't think people understand that the cannabis companies are paying up to 58% tax rate. They're paying these crazy interest loans, and it eats into the profits. But eventually, once those shackles are lifted, it's going to be a really exciting industry for the cannabis industry. And I guess the big hope for most of the CEOs of cannabis companies is that safe harbor is added, so you can actually get uplisting.
That's right. That's right.
If you could explain what uplisting means for you.
Yeah. So today, all of the U.S. cannabis companies that actually touch the plant don't have access to the U.S. capital markets. So we were not able to list on the New York Stock Exchange or the NASDAQ the way Apple or IBM or General Motors could. That is a limiting factor in terms of our ability to attract institutional investors from the United States. So many mutual funds, that are waiting to invest in the cannabis sector are looking for this exchanges to provide a leading indicator that the compliance risk is now diminished. And what's great is that some of the largest mutual funds in the world have actually already invested in us. I know that for a fact, and they've done it in spite of the fact that the indexes hasn't. So what we're seeing now is that institutions are beginning to place their bets. They're beginning to look at the sector. They're beginning to find their favorites, and they're beginning to make investments. In spite of sort of the risk-adjusted considerations that I'm sure that their compliance departments are dealing with. And so we've been very fortunate to have been able to kind of lead that process with big institutions, but others are, I think, benefiting from this phenomena too.
Yeah, I think uplisting does a lot for everyone. It brings the capital that the cannabis industry needs, I think, to grow. I guess the final point I want to talk about that is rescheduling. So currently, the DEA puts cannabis at a Schedule 1, which is ridiculous. Puts it in the same category as meth, and we need to get to a Schedule 3 or lower, I believe, to qualify for some kind of uplisting, other kind of things. But I heard an interview you were quoted as saying that you wanted on your tombstone, which is this guy did something to fix the opioid crisis.
Yep.
Right. So I think rescheduling it will also, and I've heard other CEOs talk about this, will allow for research into cannabis and really get into pharma potentially. But it also has this benefit, study after study, that it does. They said every new store that opens in a community reduces the opioid addiction.
So that doesn't surprise me at all. We have conducted research with some of the world's leading institutions that have mined data provided by different programs of ours throughout the country. And in one study, we actually found that over 68% of the pain patients that were enrolled in just as registrants in the program in New York showed a decrease in elimination or stabilization in their use of opioids to treat their symptoms. And that's huge because, all we have to do is run a sort of a regression analysis and look for how many deaths our patients suffered because of our products and how many, in turn, addictions and deaths were incurred as a consequence of people using opioids, and we'll win 10 times out of 10. And so we continue to collect that information. We continue to develop form factors that can be, optimized for medical use as well as for adult use. And we continue to make sure that when and if the policymakers are prepared to have those kinds of discussions, and the regulators, whether it's the FDA or the DEA or anybody else, they come to us, and we're able to sort of lay out a very convincing argument that isn't subjective. It's based just on the information we've been able to gather and the statistics we have on the consumers that we've supported.
Yeah, I'd like to close one final question, which is Columbia Care. I think you're one of the first to actually have a credit card. You kind of backed it up because we talked about safe banking. It doesn't allow a lot of banking, a lot of cash out there. But you guys have kind of worked around the system a little bit legally to actually provide a credit card system. I think it's been very beneficial. Higher shopping when people come in, they actually have higher baskets, those kind of things. Can you just talk about the card and some of the partners you have?
Absolutely. So we haven't actually disclosed the names of our partners because although they're sort of part of our channel of sort of getting this card in place, they're not necessarily excited about people knowing about them, because I think they're, if people knew who we were working with, they would get a flood of phone calls and saying, if you're working with them, why won't you work with us? But I think the simple answer is we spent about 18 months trying to figure out how to create consumer credit, because if you look at one of the most significant obstacles to adoption, it's the fact that you have to walk into a store with cash. And so we've begun rolling out this credit card nationally. What we saw is that our average basket size in the markets where we first rolled out our card went up by about 25%. We also are firm believers in home delivery, making sure that we can extend that reach beyond the four walls of our stores to give people the convenience that they expect in any other consumer sector. That home delivery statistics went up significantly too. So people are now considering things like automatic fulfillment, which just wouldn't be possible without a credit card. And then finally, there are other kind of attributes, which there's a safety issue, there's a quality of life issue, there are a whole range of things. There's an efficiency issue that comes with having access to consumer credit. What people don't understand is that in some markets, like in California, we can actually use that same platform as a B2B tool as well. Because it's a 3-tier system, a lot of the operators in California have had major issues in collections. So they have very significant EBITDA, but very significant negative cash flow because their working capital is basically unmanageable. We can solve for that problem by using that credit card with our counterparties, our business counterparties. And that's a very, very important thing, because imagine this: you run a business and you collect $100 in revenue. If you have to call up one of the armored car services, or if you have to call up a service to actually collect your cash and put it into a bank account, they're going to charge you anywhere between 10 and 15% right off the top. Imagine if you were trying to run a business and you lost 10 to 15% of your revenue without receiving really any value for it. So if we can find a way to actually solve for that problem, as well as the consumer problem, our view is that would be incredibly valuable. And so when we layer that on top of our national footprint, we think about it from the standpoint of consumer adoption, basket size. We also think about it from the standpoint of wholesale revenue and wholesale market penetration. And all of that gives us an enormous amount of scale to really sort of drive value through our infrastructure across the country.
Yeah, I think people can, if you haven't been involved and listening to some of the CEOs talk, you can see what they're up against, from really high IRS code rates of taxes, safe banking, where they get these 12, they need safe banking because they got 12% to 50% interest rates. They have to carry cash or do transactions in cash, which are really, really problematic for the industry, I think. So I think when the survivors or the ones that come out as leaders out of this industry are going to really benefit in a couple of years from now, because I think you're going to be lean and strong and have gone against so many obstacles in your way. But if you'd like to close with a few minutes or a minute of your time and just tell me anything I missed on Columbia Care, Nicholas.
I think that we're just very excited about where we are in the marketplace. I think that in the next 12 months we have some of the most important catalysts happening in the history of the company and the history of the sector. We have New York turning adult use. We have flower entering the medical markets. We have a massive expansion in the New York medical market. We have a massive expansion into adult use. We're the leader in New York. Virginia, we have a massive expansion in the medical market coming. We have a massive expansion into adult use. We're one of the leaders in Virginia. I would say the same thing for New Jersey, right? We're going to be maxed out in terms of our capacity for both dispensaries and canopy. And so we plan on leaning into that market and bringing into New Jersey the best products that we sell, from Colorado to California to Massachusetts. And so everything is basically coming into the New Jersey market to really accelerate that pathway to adult use. Again, one of the most important developments in the history of the sector. Next year, we're looking forward to Pennsylvania and Maryland, where again we're leaders in both of those markets, as well as in Delaware and DC, hopefully. But when we then take a step back, in Massachusetts, right, we're going to be the first downtown Boston co-located dispensary, which is a very big deal. So we're actually bringing adult use to the city of Boston, which I think is a monumental opportunity, not only for us, but also for consumers in the city of Boston. So we're very excited about that. And then we have the G-Leaf acquisition, right, which is going to materially improve not only our margin profile, but also really perfect our infrastructure nationally. So we go from being one of the largest sort of operations in the industry to being, the only operation in as many markets that we're in that actually has full integration in every one of those markets. So that means we can optimize our margin profile, make sure we have, quality supply chain, and absolutely sort of, maintain quality and margin discipline across the board. So it's a really fantastic time to be there. And those are just the things that I can kind of talk about, off the top of my head. But the list is long, and it's in every single market we're in.
Yeah, I'm in Massachusetts, and I've heard Boston is one of the most underserved cities in America right now, because there's only a few dispensaries in this. Greater Boston is like 4.5 million people, and you only have a few dispensaries to serve them.
Yeah, I mean, look, Massachusetts has taken a very thoughtful approach to rolling out its program. I think that it's still a bit of a work in progress, meaning municipalities are still trying to get their feet beneath them. But we were delighted to have been able to sort of be the first in Boston for medical reasons, and we're delighted to be the first in Boston for adult use. it's been years in the works, and we really have done our very best to work with all of the stakeholders to make sure that we contribute to the communities that we serve, and that the critics' voices are pleasantly surprised at the upside through our actions and our commitments.
All right, I appreciate your time, Mr. Vita, the co-founder of Columbia Care and also the CEO. Thank you for your time. Appreciate it.
Thank you very much. Good.